Gains in Nigeria. Dear friends, you can now pay less tax and enjoy more. See how. Yes, friend, you can now pay less tax on chargeable gains and enjoy more. The new tax laws have simplified the taxation of chargeable gains. Though the new tax laws move chargeable gains from Capital Gains Tax Act, where capital gains used to be taxed at a flat rate of 10% to income tax, where it is now taxed at 30% for companies and a maximum of 25% for individuals. The increase in tax is compensated by the numerous tax incentives and exemptions in chargeable gains. This video is all about what you need to know on taxability of chargeable gains and chargeability of gains. You will get to know the key changes in the new Nigerian Tax Act with respect to taxation of chargeable gains. You will get to know the golden rule of tax freedom, the fundamental meaning of chargeable gains, and the golden rule of chargeability of gains. You will also get to know and learn the meaning of disposal of assets in taxation as different and distinct from other meanings, how to compute chargeable gains, and how you can reduce taxability of chargeable gains, and many more. So, what do you have to do? Just be calm, attentive, focused, and follow us to the end of this video. For what you will learn in this video will certainly wow you and benefit you. We are going to be releasing this video so as to assist, educate, and enlighten the tax and non-tax community and stakeholders. So all you need to do is to just follow us as we release them. And to get the videos hot and fresh, kindly do this now. Like, subscribe, hit the notification button now, and share so that as many people as possible will be notified and sufficiently educated. And your life will certainly not be the same. And should you desire any clarification or explanation or something more, please drop your comments in the comment section or through any of our other available comments channels, as we would like you to be part of what we're doing, want to hear from you, and to continue to deepen your understanding of tax provisions, tax principles, and tax practice in Nigeria. What you will learn in this compass, you're going to learn the key changes in taxation of chargeable gains in the new Tax Act, the golden rule of tax freedom, fundamental meaning of chargeable gains, the golden rule of chargeability of gains, expressly stated non-chargeable gains in the new Nigerian Tax Act, meaning of disposal of assets in taxation as distinct from other meanings, how to compute chargeable gains, treatment of chargeable gains on asset lost or destroyed, manner of making chargeable gains, format for taxing chargeable gains in computing income tax, some tips for reducing tax on chargeable gains. The choice is certainly yours. List of the 22 interdependent compasses and about tax corp and the authors. So, key changes in taxation of chargeable gains in the new tax law that you have to know. First is hitherto, chargeable gains were taxed under Capital Gains Tax Act of 2004. However, the new Nigerian Tax Act repealed Capital Gains Tax 2004 and moved the taxation of chargeable gains to taxation of income. Consequently, chargeable gains are now determined similarly as you determine revenue profit under assessable profit or loss. Consequently, chargeable gains are now combined and taxed alongside revenue profit under assessable profit or loss. Consequently, chargeable gains are now taxed at income tax rate of 30% for companies and graduated rates for individuals, and no more at a flat rate of 10%. Now, what's the golden rule of tax freedom? And at this point, friend, I want to ask you a simple question. Do you want to be free from tax wahala? No disturbance of your sleep by a taxman. No knocking at your door by a tax lady. No receipt of long queries by your business from a tax controller. No receipt of unsolicited reminders or threats by your company. No blocking of your bank account by the tax chairman. No debiting of your bank account at the directive of a tax authority. No barging into you or your business by law enforcement officers. No forceful entry into your business premises by tax officers. and law enforcement officers. No threat of imprisonment by a law court. No selling of your business and or its assets without a court order after the tax has become final and conclusive by the Nigerian Revenue Service. Dear friend, if your answer to the above compound question is a capital yes, then obey the golden rule of tax freedom. And you ask, what is this golden rule of tax freedom? And we tell you that it is called the three C's. And you ask, what is the three C's? They are comply, comply, and comply. So what's the fundamental meaning of chargeable gains? A gain is the excess of the disposal process of an asset over the tax written down value, taking note and deducting incidental costs and expenses wholly and exclusively incurred in the acquisition and disposal of the asset. The fundamental meaning of a chargeable gain in Nigeria is that a chargeable gain is any gain that accrues to any person in a year of assessment from disposal of any form of property, whether situated in Nigeria or not, except as exempted by the Nigerian Tax Act 2025. Please note the six key components of the definition of chargeable gain. First, chargeable gain is any gain that accrues to any person in a year of assessment from the disposal of any form of property, whether situated in Nigeria or not, except as exempted by NTA 2025. Now, let's take a closer look at the components. Chargeable gain is any gain. Chargeable gain must be a gain which is calculated in accordance with sections 39 and 40 of NTA 2025 that accrues to any person. CG accrues to a person who must be either a company or an individual. In a year of assessment, there must be a clearly specified year of assessment. From the disposal of any form of property, there must be a disposal of a property or asset in accordance with section 35 of NTA and is whether situated in Nigeria or not. To be chargeable to tax in Nigeria, the gain can arise from a property or asset situated in Nigeria or outside the country, except as exempted by the Nigerian Tax Act. So if Nigerian Tax Act exempts any gain or chargeable gain, it will not be taxed in Nigeria. The golden rule of chargeability of gains. The golden rule of chargeability of gains in Nigeria is that any gain that accrues to any person in a year of assessment from disposal of any form of property, whether situated in Nigeria or not, except as exempted by NTA 25, is chargeable in Nigeria. This therefore means that aside the chargeable gains and chargeable assets expressly stated as exempted by the Tax Act from chargeability to chargeable gains, the onus lies on the receiver of any gain or disposer of any property to prove that they or their gains or property are not chargeable to tax in Nigeria. Section 34 of NTA listed three categories of forms of property which are chargeable assets, and these are all forms of property situated in Nigeria or elsewhere. Any form of assets, shares, options, rights, debts, digital, visual assets, and incorporated property generally. Any currency other than Nigerian currency, and any form of property created by the person disposing of it, which you can say there are four categories as listed. Expressly stated non-chargeable gains in the Nigerian Tax Act. Gains are claimed to a person on disposal of shares in any Nigerian company, where the disposal proceeds in aggregate, watch this please, where the disposal proceeds in aggregate is less than 150 million and the chargeable gain does not exceed 10 million in any 12 consecutive months are not chargeable. Where the shares are transferred between an approved borrower and a lender in a regulated securities lending transaction. Where the proceeds from short disposal, notwithstanding the thresholds of 150 million and 10 million, are reinvested within the same year of assessment in the acquisition of shares in the same or other Nigerian company. So these are the gains accruing to a person on disposal of shares in a Nigerian company, which are not chargeable to tax in Nigeria. You got to know that, please. Gains from disposal of assets by the undermentioned persons, where the gains are not derived from a trade or business carried on by such persons. And they include a statutory or registered friendly society, a cooperative society registered under an enactment or law relating to cooperative societies, a person engaged in educational, religious, or charitable activities of a public character, or public nature, a trade union registered under the Trade Union Act, NLC, a federal, state, or local government in Nigeria, their ministries, departments, agencies, and public institutions, government and their MDAs, gains accruing to them are not chargeable to tax. A government purchasing authority established by an enactment and empowered to acquire any commodity for export or distribution, commodity boards. A person whose land was compulsorily acquired by an authority, the land or any gain arising from that is not chargeable to tax. Other exempted gains include gains accruing from disposal of assets by an angel investor, fantastic gains, venture capitalists, private equity fund, accelerators or incubators. Gains accruing to them are not chargeable to tax. Gains accruing to pension funds and assets approved under the Pension Reform Act for rainy days. Gains accruing to an individual from disposal of investment held as part of any national provident fund or other retirement benefit schemes. Gains on disposal of a decoration awarded for valor or gallant conduct which a person acquires otherwise than for a consideration in money or money's worth. Gains accruing to a person on the disposal of an interest or right in a policy of assurance or right under a deferred annuity on the life of the assurer. Sums not exceeding 50 million naira obtained by way of compensation or damages for any wrong or injury suffered by an individual in his person or in his profession or vocation, including compensation for loss of office or employment, wrong or injury for slender entitlement. So, simply put, sums not exceeding 50 million paid to somebody for as compensation for loss of office or employment is not taxable. Where the sum, however, exceeds 50 million, only the excess amount shall constitute a chargeable gain. Gains accruing to an individual are exempt from tax in respect of disposal of an interest in a dwelling house or part of such dwelling house and land other than land used for commercial purpose immediately adjoining the dwelling house up to a maximum of 1 acre. When you say your dwelling house, your residential house, whatever gain you make on it is not taxable. But please note, the exemption under this section shall be enjoyed once in the lifetime of an individual. The consideration shall be apportioned where a person disposes of only a part of a dwelling house or a house used partly as dwelling place and partly for carrying out a trade, business, profession, or vocation. Again, agreeing on disposal of an asset which is a tangible movable property, being personal charters of an individual, shall not be chargeable gain if the total amount or value of the consideration for disposal does not, please watch this, in a period of assessment exceed 5 million naira or 3 times the annual national minimum wage, whichever is higher. Where two or more assets, whether or not forming part of a set of articles, are disposed by a person to the same person or persons acting in concert or another person, whether on the same or different reasons, the two or more transactions shall be treated as a single transaction, disposing of a single asset, but with any apportionment where necessary. Where the disposal is part of a right or interest or over tangible movable property sections 1 shall apply in relation to the asset as a whole. Gains accruing to a person from disposal of motor vehicle used solely for private or non-profit purposes. The exemption shall be limited to not more than 2 motor vehicles by an individual in a year of assessment. So if you sell your vehicle, 1 or 2 of them, any gain you make is not taxable. Gains accruing to a person from disposal by way of gift, an asset acquired by way of gift, is not taxable. Meaning of disposal of assets in taxation and in computing chargeable gains. Please pay attention here, because what you call disposal in ordinary setting is not the same thing as the tax calls disposal of assets. So let's know what the tax law says is disposal of assets. The meaning of disposal of assets in taxation is different from the ordinary meaning of disposal of assets. Please take note, as we will now explain in line with the provisions of the Tax Act. Section 35(1) of NTA 2025 states that for the purpose of NTA 2025, there is a disposal of assets by a person where any sum is derived from a sale, lease, transfer, an assignment, a compulsory acquisition, or any other disposition of assets, subject to any exemptions as may be provided in Chapter 8 of the Tax Act, which deals with tax incentives. Disposal is deemed to have occurred notwithstanding that no asset is acquired by the person paying the sum, and in particular, where the sum is derived by way of compensation for any loss of office or employment, received under a policy of insurance, and the risk of any kind of injury or damage, or the loss or disposition of assets, received in return for forfeiture or surrender of a right, or for refraining from exercising a right, and received as consideration for use or exploitation of any asset. For market value consideration or purposes, the acquisition and disposal of an asset by a person shall be deemed to be for a consideration equal to the market value of the asset where the person acquires the asset, otherwise than by way of a bargain made at arm's length, wholly or partly for a consideration that cannot be valued, as trustee for creditors of the person making the disposal, or upon devolution on death as a personal representative or legatee of a deceased. Where a person disposes of an asset by way of gift other than asset acquired or disposed by on devolution or death, the person acquiring the asset, as it relates to the interest taken by the person, be deemed to have acquired the asset for a consideration equal to the amount for which the asset was last disposed of by way of a bargain made at arm's length, or where the amount last disposed of by way of bargain made at arm's length cannot be ascertained, for a consideration equal to the market value of the asset on the date of the disposal. How to compute chargeable gains? Please pay attention here. There are 2 ways of computing chargeable gains, and these are: 1, where capital allowance has been granted to the asset being disposed, and secondly, where capital allowance has not been granted to the asset being disposed. Where capital allowance has been granted to the asset being disposed, chargeable gains shall be computed by subtracting the tax written down value from the net disposal proceeds, which is calculated as after deduction of incidental expenses of disposal. This is chargeable gains equals net disposal proceeds less tax written down value. Where no capital allowance has been granted to the asset being disposed, chargeable gains shall be computed by subtracting total cost of acquisition from net disposal proceeds, calculated after deduction of incidental expenses of disposal. This graphically is this way: chargeable gains equals net disposal proceeds less TCA. Section 39 of Nigerian Tax Exemption Act 2025 state that the gains chargeable to tax shall be computed as follows. Please more attention. Where capital allowance has been made in accordance with capital allowance mechanism in respect of an asset under use for a trade, business, profession, or vocation, only the residue of that asset shall be deducted from the disposal proceeds for the purpose of computing chargeable gains. And where no capital allowance has been made in accordance with capital allowance mechanism in respect of an asset used for a trade, business, profession, or vocation, the chargeable gain shall be determined by deducting from the disposal proceeds the amount or value of the consideration in money or money's worth incurred wholly and exclusively for the acquisition of the asset. Any incidental cost incurred wholly and exclusively for the purpose of disposal of a chargeable asset is deductible from the disposal proceeds for the purposes of determining the chargeable gain. Any expense deducted for income tax purposes cannot be deducted for chargeable gain. Very important. Any expense deducted for income tax purposes cannot be deducted for chargeable gain. That is double counting or duplication. Chargeable gains on assets lost or destroyed. When an asset is lost or destroyed, and a capital sum received by way of compensation for the loss or destruction is applied within 3 years of receipt in acquiring another asset in its replacement, the owner shall, where the compensation received together with the residual or scrap value is greater than the cost of the asset acquired in replacement of the lost or destroyed asset, be deemed to make a chargeable gain, and lower than the cost of the asset acquired in its placement, be deemed for the purpose of capital allowance to have acquired an additional asset for an amount equal to the cost of that new asset, less the compensation together with the residual or scrap value. Except for the additional asset acquired under Section 1B, allowance to be claimed on the new asset for the purpose of capital shall be limited to the residue of the old asset, if any. Friends, let us demonstrate these provisions here with some numbers. First scenario, capital sum received is 8 million naira. Cost of replacement of the asset, 9 million naira. And the residual value is 2 million. So our simple equation is this. Chargeable gain equals CSR plus tax written down value minus cost of replacing the asset. Now, when you plug in the figures, the numbers, you have chargeable gain equals 8 plus 2 minus 9 equals 10 minus 9, which will give you 1. So our chargeable gain is therefore 1 million naira. Now, scenario 2, assuming the capital sum received is 4 million. In the first one, it was 8 million, but here it is 4 million. And the cost of replacement of that asset remains 9 million. And our residual value remains 2 million. So our simple equation is, again, this way. Chargeable gain equals cost, capital sum received plus tax written down value minus cost of replacing the asset. And when we plug in the figures again, we'll have chargeable gain equals 4 plus 2 minus 9. 4 plus 2 will give us 6. Then it will now be 6 minus 9, which will give us minus 3. This is therefore chargeable loss instead of chargeable gain. Now, value of additional asset. To calculate the value of additional asset, it is simply the capital sum received minus, to calculate the value of additional asset, you will have the cost of replacing the asset minus the capital sum received plus tax written down value. And again, if we plug in our figures from the above scenarios, we will have value of additional asset equals 9 minus 4 plus 2, which will give us 3. So capital allowance for the new asset shall be limited to the residue of the old asset, which is 2 million instead of 3 million, meaning that you will not be granted capital allowance for the 3 million calculation we made, but since the residue of the old asset was 2 million, your capital allowance will be limited to 2 million. So this is the equation for lost or destroyed asset. Now, what's the manner of making chargeable gains? Very simple. Chargeable gain is added to assessable profit as per section 41A of Nigerian Tax Act 2025. Section 4(1) of NTA state that income, profit or gains of a person chargeable to tax are the income, profit or gains of the person accruing in or derived from Nigeria, including profit or gains from trade, business, professional or vocation, for whatever period of time such trade or business may have been carried on. So you can see now that the Tax Act mentions profit and mentions gain. So the gain here is the chargeable gains. That's what Tax Act is talking about. Chargeable gain is aggregated as part of assessable profit. That's profit before tax or adjusted profit. See below. Now, here is a format for you to compute tax where you have chargeable gains. We have two scenarios. We have two columns here for company and individual. This format, once you have this format, you can effectively compute the tax of a company or an individual. So it starts with gross turnover. Gross turnover is the total amount you earn in a year by your invoice. So from that gross turnover, you will less all your allowable costs and expenses. Please mark what I said there. I said you will less all allowable costs and expenses. So if the expenses, if there is an expense or cost that you incurred, which is not allowed by the relevant sections of the Act, they will not be allowed. So to get your profit before tax, as per tax calculation, it has to be gross turnover less allowable costs and expenses. Then you come to profits before tax. Then you less loss brought forward, and you have remainder of accessible profit or income. Then you now less capital allowances. Then you now come down to total profits or income. For companies, you can stop here in the sense that your total profit is also called your chargeable profit or your taxable income. But for individuals, you have to go further. You have to less eligible expenses such as your contributions to national health, rent allowance, contribution to housing and all that. Those constitute your eligible expenses. Now, when you remove those eligible expenses, you now come to what we call chargeable profit or taxable profit or income. It is this taxable profit or income that you now hit the approved tax rate. For companies, it is a flat rate of 30%. For individuals, it is graduated to a maximum of 25%. So when you apply those rates, you now have your tax liability. Now, some tips for reducing tax on chargeable gains. Here are some tips you can apply to reduce the tax they hit on you on chargeable gains. First, please be proactive. Seek advice timely where necessary. Know your tax law very well. Know your chargeable gains tax law very well. Keep a comprehensive register of all tax benefits and incentives. Keep a comprehensive register of all tax compliances. Clearly know and utilize exempted gains well. Ensure that the acquisition cost of the asset complies with the golden rule of wholly and exclusively. Ensure that the incidental expenses of either acquiring or disposing the assets comply with the golden rule of wholly and exclusively. Ensure that the asset was acquired for the sole purpose of the business. Ensure that the asset was acquired and used in the basis period for which you are claiming. and also ensure that the asset was in use at the end of the basis period. Otherwise, the tax office will not allow those. Calculate chargeable gains accurately and timely. Charge all chargeables, pay all payables, remit all remittable. Obtain and keep documentary evidence for all assets. Keep comprehensive and accurate record of all business transactions. They will be required sometime, including the documentary evidence of your expenditure. Most importantly, regularly consult or hand over your tax matters to tax corp. The choice is yours. So you have seen it, friends. The choice is yours. You can harness and get the benefit of chargeable gains and get lower taxes. And one thing we assure you that tax corp will always be there to answer your questions, to make clarifications that you desire. And here are the list of the 22 interdependent compasses. And again, we encourage you to go through them and pick whatever tax subject that you want to deal with, and go through the tax corp channel, and you'll see the video that can help you deepen your understanding and knowledge of that. And if you desire anyone that is not here, just drop in our comment section and we'll make clarification. So some of you already know about Task Corp and the principal consultant. But for those who don't know, I want to say that Task Corp is a Nigerian tax consulting firm which specializes in tax matters. Prince Chidi, FCA, FCTI, MBA, is the principal consultant. Prince Chidi is a licensed fellow of the Institute of Chartered Accountants of Nigeria, ICAN, and the Chartered Institute of Taxation of Nigeria, CITN. Tax Corp and Prince Chidi have provided tax services to numerous individuals and corporate bodies in both the public and private sectors, locally and internationally, since 1990. The beneficiaries include the Nigerian Revenue Service, formerly the Federal Inland Revenue Service, Revenue Mobilization, Allocation and Fiscal Commission, RAMFAC, State Internal Revenue Service like Lagos, Abia, Enugu, and so many, Kano, including Federal Capital Territory, Internal Revenue Service, and many private companies and individuals. Dear friends, this is all you need to know about chargeable gains. If you desire more, please contact us through all our channels and you will do better. Thank you.